Ladies and gentlemen, the session will now commence. Please turn your attention to the stage.
Hi there. Welcome. Welcome to the Milken Institute's London Summit. My name is Kadhim Shubber. I'm a journalist at the Financial Times. I cover enforcement in the US. Looks like we have a packed house today. We have a wonderful panel here to talk about stability and growth and the unintended consequences of post-crisis financial regulations. On my left, my far left, we have Scott O'Malia. He's the Chief Executive of the International Swaps and Derivatives Association. I have Jiří Król, the Deputy Chief Executive of the Alternative Investment Management Association. To my far right, we have Brent McIntosh. He's the General Counsel of the U.S. Department of the Treasury. And finally, we have Michael Pivovar, the Executive Director of the Center for Financial Markets at the Milken Institute. So to start, let me just ask a very simple question. Scott, have we done enough to make the financial system safe?
Well, certainly over the past 8 years, we have taken significant steps to make the system much safer. There's $1.9 trillion in Tier 1 capital that is now supporting bank balance sheets. 80% of interest rate trades today, 80 to 90% depending on the jurisdiction, of interest rate trades today are being cleared. We have trade execution across jurisdictions in over 15 jurisdictions, which provide additional transparency. There are additional reporting requirements, both regulatory and market reporting, that provide much more data to the market and to the regulators. And then there's the initial margin rules that are being implemented today that are going to increase the non-cleared trades, both requiring initial margin and variation margin. And so far, beginning in 2016, we have nearly $1 trillion in variation margin backing non-cleared trades. So, you know, in a short period of time, we've kind of implemented these rules, and we now have the results to show for it. Now, this has, of course, made the system much more expensive. There's a lot of regulatory friction between the jurisdictions being inconsistent, and obviously this all started in the Pittsburgh summit, in which all the G20 countries agreed to align their rules. Now, they are largely aligned, but there's not a lot of consistency, and there's not a lot of recognition between the parties. So each of these jurisdictions require participants to live by the rules in each country, and we're not getting the efficiency of having cross-border harmonization. So I think there is a lot of safety and soundness, but there's a lot of work to be done here. And
when you weigh up the costs to the financial sector, and obviously the context in which these rules were put in place, which was the financial crisis, which was hugely damaging. I mean, how do you weigh up whether it's worth it?
That's a tough question, right? The system. The goal was to make the system safer, more transparent. Now we've done a lot of those things. Now we're kind of looking at the balance between these two things, and you have to look at these individual rules and saying, all right, the system is safer, but could they be optimized? Could we get more cross-border harmonization? Must we have data reporting in 19 jurisdictions, all done differently, which prohibit regulators from actually seeing across jurisdictions? They're not sharing information, right? The goal was to see risk across jurisdictions, and that's not happening today. When you look at the initial margin requirements, you're going to be phasing in over 9,000 participants, many of which will never exchange a single dollar of initial margin because they fall below a $50 million threshold. So when you really begin to look at these rules and say, are they optimal? Are they achieving the things that we intended? Yes, by and large, they are, they made the system safer. But when you look at them and think about how you optimize the rules, there's a lot of work that can be done there. And you're not going to be sacrificing, by optimizing these rules, you're not going to be sacrificing the financial security and soundness of the system. You're just going to make it more efficient, more consistent, and probably more risk appropriate at the end of the day.
Mike, do you want to jump in?
Sure, yeah. So when I think about sort of the response to the financial crisis we had, which was, I was thinking back to this, it's almost exactly 10 years ago today, and thinking about what I was doing, and I happened to be working in the White House and the Council of Economic Advisors and sort of watching this unfold in real time. And it became very, very apparent at that time. There's a couple lessons that we learned. Everyone kind of has their favorite narrative of the crisis. But a couple things have really, really stuck with me. One was the sort of lack of regulatory transparency into various aspects of the market. And so therefore, the policymakers, the government officials at the time were making decisions in real time without the benefit of having full information of what was going on. So part of my job was to try to figure out which financial institution was going to be the next one under stress. You know, if you think back to 10 years ago, it was which bank is next, which financial institution. You know, AIG kind of came out of nowhere. And so, for example, you know, in Scott's world, in the over-the-counter derivatives market, at the time, the regulatory agencies in the United States were actually prohibited from collecting data on all of the bilateral sort of exposures that the financial institutions had. So when I was trying to figure out like who had exposures to whom, we looked at all the regulatory data, we looked at all the public filings at the SEC, and none of that information was useful because we didn't have any of that. As part of DoddFrank and the response to the crisis, we now have regulatory transparency to that. So that is in fact a good thing. And in terms of how we think about the benefits and the costs of it, right? So I think of things like that in different buckets in the response to the crisis. So that would fall into the bucket of well-intended, was intended to fix a particular problem and seems to be working well. So the SEC and the CFTC, two regulatory agencies in the United States, are collecting this data, and now the regulators and the government officials have access to this data. A second bucket of types of responses would be well-intended, but with the benefit of having 10 years of the regulatory agencies working on this, maybe there could be some changes to sort of tweak some things, not necessarily roll them back, but taking the benefit of the fact that the agencies have been working this. And as an example of that, in the credit rating agency regulatory framework. So prior to the crisis, there had just been a brand new regulatory framework set up to regulate credit rating agencies. And we know that credit rating agencies were at sort of the heart of the crisis. There were a lot of things that ex post weren't necessarily regulated or rated as AAA that were in fact they had rated as AAA, and so maybe getting some better regulations around the credit rating agencies. And there was a number of provisions in Dodd-Frank that gave the Securities and Exchange Commission oversight of the credit rating agencies. There's a number of things that are good, but there's one provision, for example, that requires the Securities and Exchange Commission to annually look at 8 different specific things within every credit rating agency. Very prescriptive legislation that requires the SEC to do this. And this has turned out to be a problem. Why? Because it takes the SEC an entire year to meet the statutory mandate of Dodd-Frank, which is to actually go through and examine all those 8 things. Why is this a problem? Because they've identified that most of these 8 things are not a problem anymore. When it was written, maybe perhaps these are 8 areas that they wanted to look at, but now it's just they're just checking the box to fulfill the statutory mandate. And the real cost is the opportunity cost, is that the regulators have found that there are other areas that they think would help investors, help the safety of the system, that they don't have time to look at with limited resources because they're spending all their time complying with the statutory mandate of Dodd-Frank. And then there's sort of a third bucket of responses to the crisis that were thrown into Dodd-Frank, which had absolutely nothing to do with the crisis, but as Chief of Staff to President Obama, Rahm Emanuel, famously said, don't let a crisis go to waste. And so there was a lot of special interest things that were thrown into Dodd-Frank that put a lot of burdens on public companies in the United States that have nothing to do with the financial crisis, make the cost of going public much higher in the United States than in other jurisdictions. We're seeing fewer private companies go public. We're seeing fewer private companies choose, or foreign companies choose to list in the United States. And so those are examples of just additional costs in the system that have nothing to do with the crisis. And so when looking at each of these things, there are things that fall into each of these 3 buckets that we can do to help sort of fix the unintended consequences in the system.
And so in your mind, when you look back at Dodd-Frank, I mean, what in there has had the actual effect of making the system safer? Because obviously there's capital requirements, there's transparency, there's a whole range of stuff. What are the things that, in your mind, are the core of it that actually make it safe? And then how much extraneous stuff in your mind is there?
Yeah, so on the let's take the banking side, right? So one of the things we learned in the crisis was that banks did not have enough capital, and they were too reliant on debt, and not only the banks, but other institutions, and too reliant on short-term debt. And so there were a number of things in Dodd-Frank and Basel regulations that up the capital requirements, improve the liquidity requirements, and all those sorts of things. And they've certainly improved the resilience in the system. But even the banking regulators are taking a look at this and talking about terms like efficient resilience, right? So there's a number of things that attack capital requirements, liquidity requirements, collateral requirements, and they've all been done in sort of isolation in terms of let's fix this problem. And sometimes it's additional cost layered upon cost trying to attack the same problem. And so there's an opportunity to try to figure out, can we lessen the burden of these without affecting the resilience on this? And certainly, as I mentioned, the regulatory transparency is a huge, huge part of the make the system safer. The fact that the two agencies in the United States, the Commodity Futures Trading Commission and the Securities and Exchange Commission, are now collecting all of this data on all the swaps transactions. Some of them are being cleared. There's an appropriate amount of clearance that's involved. We don't want to push too many things into clearing houses because now we've created just another too big to fail type of institutions that are there. But certainly it's a matter of just calibrating these things just right.
And Brent, what's your view? I mean, what in your mind is the core of the post-crisis regulations that make the system safer versus the rest of it, which perhaps doesn't get to that core issue?
Yeah, let me broaden the lens a little bit, taking Mike's construct. And like Mike, I was in the White House in 2008, and at that time we were very much trying to triage the next problem. Now, fast forward 10 years, and we have the ability to look at the DoddFrank reforms and attempt to evaluate which of these fall in which buckets. And so, when this administration came in 2 years ago, we decided at the President's instruction to sit down and go back to first principles on financial regulation and take a set of first principles that were articulated and go through systematically the financial regulatory reforms in the financial regulatory system that existed and attempt to identify where we thought there were, where there had been beneficial changes, where we thought there were tweaks to be made, and where there were things that we thought were not of value. And so those principles are things like we believe that consumers should be able to make informed, independent choices. We believe that the slow recovery of the past 10 years was not beneficial to consumers, and there are a number of things in Dodd-Frank that we thought were standing in the way of economic growth. That regulation of financial institutions ought to be efficient, effective, and tailored to what the purpose of the regulation was, and only to that purpose. And that regulators, like regulated parties, ought to be held responsible for their actions. And so we went through with massive public engagement, whether it's industry, whether it's the various regulatory agencies, whether it's our foreign partners, and we went through systematically and prepared a series of reports on financial regulation, first on banks and credit unions, second on asset management and insurance, third on capital markets, and then more recently on FinTech, and we're working right now on evaluating crypto and distributed ledger technology, which is its own challenge. And when you look at that, you find that there are a number of places where we thought that Dodd-Frank was not well tailored. So, for example, there was a one-size-fits-all view of financial regulation that, for example, imposed enhanced prudential standards on some regional banks that there really was very little benefit to that in our view. There were a number of things that Mike adverted to with regard to capital formation, where there were a number of disincentives to companies going public, to listing in the United States, that we thought were unnecessary. For example, there were a number of disclosure requirements imposed that had very little to do with investor behavior. And so there are a lot of recommendations. I'm not going to go chapter and verse, but we have gone through and attempted to articulate where we think there are changes to be made. A number of those changes ended up being passed in the recent Economic Growth Act that passed out of Congress. But there are a lot of changes still to be made, a number of which require legislation, others of which we can do through executive branch regulation. But there are, and then we're looking forward, we're applying these principles as we go forward regulating. When we see a regulation that's proposed, we evaluate it based on those core principles and attempt to determine, is this the sort of thing that is going to forward to promote consumer choice? Is it going to promote economic growth? Is it consistent with the regulators' obligations to regulated parties?
And you mentioned the recovery or in the economic growth following the implementation of DoddFrank and the other regulations. I mean, in your mind, was that a significant drag on growth after the recovery?
We think there are a number of places where it hurt, for example, consumer credit, the availability of consumer credit, credit to small businesses, where there was a lack of, there were a number of instances in which financial institutions felt either uncertainty about the operating environment. There's no question that it hurt the Main Street investors because of the incentives it created for companies to remain private or to go private and not to go public. There are half as many public companies in the United States as there were 20 years ago, and that's not great for Main Street investors, and it's not great for capital formation.
And Jiří, in terms of the the impact on growth, someone like me, I'm a humble kind of guy, and so after the crisis we had, I think we averaged around like 2% growth yearly in the U.S., which seems fine to me. But I guess the question is, I mean, how do we weigh up the cost of the regulations that make the system safer, and say, well, if it was different, we could have had much faster growth. I mean, how do you weigh up the cost of safety versus the hit to growth?
Well, first of all, not everybody lives in the US. And if 2% growth is fine, if you look at some of the continental European countries, they've not had that type of growth. And I think it's absolutely right to say that the banking system needed recapitalization, needed better liquidity rules, we needed better management of risk when it comes to the derivatives markets, and we all supported that. Where the cost-benefit analysis becomes interesting is where when you have to look at how your system works overall, and do you have other forms of capital that are capable of stepping in and ensuring that markets can function properly. And where you have open systems, relatively speaking, where capital can find its way towards the end user, you have seen less of a disruption in growth as a result of the necessary reforms. I'll give you an example. The UK, since 2008-9, 2/3 of all the net new finance provided to the non-financial private sector has come from the capital market. Primarily the bond market, but also the direct lending market, for example. In a number of European countries, you didn't have the ability to do direct lending, something which has become a pillar of mid-market finance in the US, for example, over the last 5 years. So the impact of the reforms was extremely uneven, and it's still playing itself out. We're not at the end of it, because if you look at countries like Italy and Germany and compare the two, you'll see very well that the reforms are far from being finished, and the impact of reforms is far from being finished. And the real challenge for policymakers is ensuring that the system, and we see it, the system can work, markets do work. It's just that you have to make sure you don't put unnecessary barriers there for them to be able to play these things out.
And are you saying that the sort of the pre-crisis or the sort of the more historical features of the European markets versus the US markets have had more of an impact on post-crisis growth than anything government or anyone else has done since then?
In many ways. When I was still working for the Czech presidency of the EU Council back in the day, I remember the early days of the crisis, there was almost a congratulatory mood in some of the council meetings because people felt like finally the European economic model and financial model is proving to be more resilient than the US capital markets-based model. And this was reality. And then fast forward 10 years, we're talking about trying to
finally revive the capital markets union in the EU. But when you look at those efforts, they seem to be fairly small in terms of what could be done going forward. And when you look at the regulatory response on the capital market side in the EU, the heavy ballast put on the asset management, the investment banking sector, it's difficult to see how you're going to go ahead and support that growth in the non-bank finance sector. So this is going to be the big policy challenge for Europe, really making the capital markets union a real thing, because otherwise growth will suffer. Because I just don't see any other way of ensuring a financial system that A, provides the necessary finance, and B, is safe enough and is not overly reliant on one single form of financing.
Can I follow up on that?
Yes,
Right. So Jiří brings up an excellent point, right? So what we know is that the key to economic growth and stability is having not only a strong banking sector, but a strong capital market sector. What you saw is sort of in the wake of the financial crisis, kind of to Jiří's point, was that you sort of get the dominance of the banking regulators, the prudential regulators, who have a particular view of the world where they want failure is not an option, right? Where if you're a prudential regulator, a banking regulator, you want to make sure that your bank is safe and that there's no way that it can fail. And so how do banking regulators and those people with that mentality view the capital markets? Well, those are shadow banks, right? Somehow it's operating in the shadows. And as those of us that know in the capital markets, that's the exact opposite, right? The capital markets are very heavily regulated, very well regulated. And in fact, failure is an option. That's the whole point of putting entrepreneurial capital at risk. And that's where you get the growth from. And it also provides sort of like a shock absorber between the capital market sector and the banking sector. And so what you saw in the wake of the financial crisis, both in Europe and the United States, was this mentality of talking about sort of the shadow banking sector and this idea of what they call macro-prudential regulation, looking across system-wide and somehow using bank capital tools or bank regulatory tools to try to fix sort of the capital markets. And there was a lot of debate for a long time for those of us that were market regulators to saying, no, this is a very different type of, those regulatory tools the bank regulatory tools aren't as appropriate for the capital markets. You saw it most visibly in the United States with the Financial Stability Oversight Council, which is the council of regulators, right after the crisis started to look at designating non-bank financial institutions as supposedly systemically important financial institutions and looking at, for example, designating insurance companies, right? People say, well, we bailed out AIG, so they must be systemically important. Well, no, we bailed out AIG's creditors, who happen to be the banks, right? And so it's for me, it begins and ends with sort of making sure on the prudential side with the banks and letting the capital markets and the insurance markets put risk capital work and that sort of thing. And then there was a move to actually start designating asset management companies. And what you saw over time, though, is that cooler heads prevailed, and we're seeing the pendulum shift back into to seeing that we need strong capital markets. That's where growth comes from. That's where the resiliency comes from. And the administration moving away from designating insurance companies and moving towards looking at activities instead of an institution-based framework.
Yeah, if I could jump in, Mike makes an important point about our Financial Stability Oversight Council, which is that, well, to give an example, I was at a conference a couple weeks ago where a former Obama Treasury official said, basically, we spent a lot of time on the Oversight Council designating firms. We should have been spending time trying to coordinate regulation in the United States and combating regulatory fragmentation. And that certainly was our view upon review of the work of the FSOC, was that just going and working through entity-specific designation was not getting at the issues where the FSOC could actually be valuable. The FSOC needed to be looking at the activities that were potentially threatening, systemically threatening, and working through those and working through regulatory coordination, combating regulatory fragmentation, and in that sense, there was a value for bringing the regulators together in a room to talk about their common challenges, but that the way the FSOC had been used in the immediate post-DoddFrank era was not a particularly effective way to use it.
And I think because I was looking at doing some research online, and so last year a predecessor of yours wrote a letter to the Wall Street Journal about the Treasury's shift in approach with regards to the FSOC, and he said, Treasury's zeal for deregulation has faded. and said that it was basically a power grab.
Yeah, we have a disagreement as to that point. This is a predecessor of mine. I think his take is that the FSOC shouldn't be doing any of this, including the evaluation of activities. We don't think that's right. We think there's a role for the members of the Financial Stability Oversight Council, who are our federal regulators plus some state regulators, to get in a room and look at where they think there are potential threats. But we don't agree that that's well done by simply identifying particular entities and ignoring the rest.
Can I pick up on something? So he brings up a really important point, the fragmentation of regulation in the United States, right? So you travel internationally, you look at jurisdictions and their approach to financial regulation, and oftentimes the debate is framed into, do we want a single peak financial regulation, one uber regulator that sort of regulates everything, or do you want twin peaks? Do you want a prudential regulator or a markets regulator? In the United States, I have what we call the rolling hills model of regulation, right? We don't have one, we don't have two, we have three banking regulators in the United States: the Federal Reserve, the Office of Comptroller of the Currency, and the Federal Deposit Insurance Corporation. We don't have one markets regulator, we have two markets regulators: the Securities and Exchange Commission, the Commodity Futures Trading Commission. And DoddFrank did nothing to sort of rationalize this. In fact, it added to the alphabet soup of regulators. It added the CFPB, the Consumer Financial Protection Bureau, the Financial Stability Oversight Council, FSOC, the Office of Financial Research, OFR. And it creates a very much fragmented regulatory system. And so the need for coordination among regulators is huge. I mean, if you think of like the Volcker Rule, for example, right? This is the one that prohibits banks from engaging in proprietary trading or investing in hedge funds that in fact do this indirectly. This is a rule that's been written by 5 different regulators, right? The 3 banking regulators and the 2 markets regulator. Forget about the coordination on the front end, but think about firms trying to comply with this regulation now have to get answers from 5 different regulators on this. And so what you get from the natural reaction from the institutions that are subject to this is that they're going to take the most conservative, most extreme one. So even if it wasn't intended to have the effect that it's actually having, and in fact the banks pulling back from various markets, and there's potential illiquidity effects in some of these markets, the reasons why it's having that effect is because of you have this fragmented regulatory system that is not well coordinated, that Treasury is trying to make sure is more coordinated so that we can actually get sort of the balance right in this.
I think for businesses operating globally, it's even worse because post-Brexit, if you're here in the UK, you're going to have to deal obviously with the FCA and whoever is going to be your favorite European regulator, whether in Ireland, Luxembourg for asset management businesses, which are the jurisdictions quite commonly used. And of course, if you touch US investors, then the SEC and the CFTC are there making sure you're registered, you report pretty much the same data, but not quite the same data. You comply with pretty much the same record-keeping rules, but not quite the same record-keeping rules. So the overlap of the regulatory regimes, where previously you had 1, max 2 regulators, now you're going to the world of 3 to 4. As well as the market fragmentation, are to me something which is probably one of the biggest threats to growth stemming from financial regulatory developments. Because what we're seeing now is this kind of tit-for-tat regulatory intervention increasing. And we just saw yesterday that the Swiss authorities publish a decision basically saying they're going to potentially prohibit European firms from trading in Swiss markets because Europeans are unlikely to extend the equivalence on the share trading obligation. So if we keep on going like that, then it's going to be incredibly difficult to make sure that capital can flow across borders. And that's super important, again, for Europe, because most of the capital, well, the private capital as well as the public capital that we see coming through is not necessarily coming from continental Europe itself. So it's very important for Europe to make sure that it remains open to the flows of capital, but what it is doing at the moment is erecting barriers to that, and that's probably not a good thing.
So I would agree with all of these points. Very important that we have harmonization among the regulatory agencies within the U.S., but then you think about, to Yuri's point, how global capital markets function, particularly the wholesale markets. They were global beforehand without significant rules in place. Now we have rules in place, and there is tremendous alignment at the high level in terms of the outcomes-based approach. to aligning these rules broadly, trading, clearing, additional capital, data reporting, as Mike said. So we have this in place, and we're about 75% there, right? We have the rules in place. But now we have a regulatory structure that doesn't recognize one another, which creates a lot of friction and fragmentation. U.S. person definitions, limit where U.S. persons can trade and under what rules. The rules are in place today, and we need to think about how we move capital back and forth in the efficient level. So I think that's one of the biggest frustrations is the lack of cross-border harmonization. And in fact, if we're at 75% today, there's a bit of a receding right now in terms of location policy around CCPs. That's very dangerous in terms of risk management, and it's also just wildly inefficient. If under a Brexit there is a hard Brexit and we don't recognize LCH where 90% of interest rate products are cleared today, you're going to end up ripping that apart. You're going to create fragmentation. There's a lot of efficiency through netting and consolidation, compression within a clearinghouse. And if you insist that you put Euro clearing back on the continent and not utilizing LCH here in London, you have a lot more inefficiency. It's going to cost a lot more for pension funds. You're going to reduce the return. They're not going to be able to have the assets, and pensions aren't going to have the returns they expect to support lifestyles going forward. You're going to make it extremely difficult to move capital to where it is today, London, New York, Paris, wherever, to where it needs to be deployed. Southeast Asia, Latin America, Africa. We have $1.7 trillion in need in economic development in Asia alone. That capital needs to come from somewhere to build economic growth so we can all thrive. The other bit is looking at it from a risk perspective. I think we implemented the rules very quickly and said, all right, we'll sort it out later. Now we can take that, use the data that we have, understand the ramifications of these rules, look at a cross-border analysis and say, all right, do we have appropriate risk rules? When you think about capital rules, you want to make sure you have a global alignment. You don't want to have an unlevel playing field that's bidding, create a competitive imbalance for European banks versus U.S. banks or Asia banks versus European banks, right? You want a level, consistent, risk-appropriate level playing field. To Mike's point, you don't want to develop rules that are, safety at all costs when you're sacrificing economic growth. So you need to find that balance where you can efficiently manage the risk and then still get the right behaviors. I think there's a lot to do in terms of optimizing the rules around non-cleared margin as well. Not everything should be in a clearinghouse. You don't want clearinghouses to be the next systemic threat. They are hugely important right now. We have much more clearing today. With interest rates, 80% of interest rates in clearinghouses. You need to manage that quite effectively. You cannot cheat and lower standards on a global basis. So you need good, robust risk, resilience, and recovery solutions around that. Conversely, you need a risk appropriate for non-cleared margins. If clearinghouses are going to have most of the risk, how do you think about those items that should not be in the clearinghouse? How do you allow pension funds or asset managers to manage that risk outside of clearing? These things all have costs, and you want to look at those costs and calibrate them appropriately. Get the best risk management you can, but not at all costs, not at the cost of economic growth.
Yeah, and just to pick up on that, because what your answer is sort of making clear is there is a lot that is yet to be done. Even after I think you had that sort of memorable phrase about the years after DoddFrank at the SEC being like the DoddFrank death march, or
exactly.
Like that.
That's exactly. I mean, the opportunity cost of Dodd-Frank. So, Dodd-Frank was 2,319 pages, and people think, well, that was the end of it, right? The administration at that time took care of financial regulation. No, it just began the conversation, because what it really did was told the regulators promulgate 400 new rules, of which the SEC was responsible for about 100 of them. And the opportunity cost of using up all the bandwidth on what I call the Dodd-Frank death march was that the SEC was not able to look at other things like its investor protection mandate or its capital formation mandate. It was simply just about marching forward on a lot of these Dodd-Frank issues.
And because I guess so Janet Yellen gave a speech. I think it was sometime in the last 2 months, and the text came out recently, and she talked about there being areas where the regulatory burden should be reduced, and that some of the recent reforms have been sensible, but she also said that the focus was quote, diverting attention from financial stability work I'm basically arguing that actually the job isn't quite done yet, or the death march isn't over yet. I mean, are there areas where, as well as thinking about growth, the fixing up job hasn't quite been completed yet?
Yeah, so I would say in the derivatives, over-the-counter derivative space, right? So, Scott's been talking articulately about that. It was divided up, the regulatory jurisdiction was divided up in the United States between the Securities and Exchange Commission, the Commodity Future Trading Commission, and the CFTC went forward. Most of their mandates were in Title VII at DoddFrank and the OTC derivatives, and they went forward on a number of different rules and regulations, and the market participants are subject to both SEC and CFTC jurisdictions, and the SEC has been quite slow in the over-the-counter derivatives regulatory framework going forward because we had so many other things to do. So recently, the chairman of both agencies, Chairman Giancarlo from the CFTC and Chairman Clayton from the SEC, have announced that the SEC and CFTC are going to coordinate to try to figure out what to do moving forward. Because some of these, the CFTC has moved forward, put things in place, and to Scott's point, there's an opportunity to look at whether or not we've got the balance right on these, and the SEC has not done anything yet. So there's an opportunity now to, with 10 years of sort of hindsight and working through this, is there an opportunity for the CFTC to revisit what's out there? What about the SEC moving forward on these? And to Brent's point, to have these things harmonized, because it's oftentimes the same market participants that are subject to multiples of these things. So certainly in the over-the-counter derivative space, there's an opportunity to move forward on harmonized, efficient, effective, and appropriately tailored regulations.
And I just point, it's a little stuff. What is the definition of a swap dealer, right? What is the definition of U.S. person for the application of international rules? By agency, they differ. And the prudential regulators have one definition, and the market regulators another. How are you supposed to comply with two sets of regulation when they're identical, let alone cross-border, but when they're within one government? So that, from our members' standpoint, this is really frustrating. So it is appropriate. We're thankful that we do have SEC chair and the CFTC chair working well, and their commissions overall. We're also supportive of the Treasury reviews. All of those documents highlighted in a very, unemotional way, what are the opportunities to optimize this and make some serious fixes without sacrificing safety and security. So I think we're in a good spot. We just need to keep the momentum going.
And Brent, I just wanted to talk a little bit about the deregulatory work that you're doing at the moment. So there was the executive order from Donald Trump last year, which said, for every new regulation, you got to get rid of two. And can you talk a little bit about how that sort of works in practice?
Yeah, it's a great question. I mentioned earlier we're working on sort of regulatory hygiene, which is to say there are a number of the natural incentive as a former political science student, the natural incentive of regulators is to regulate. But if you look at the regulations on the books, there are a lot of regulations that are either outdated, they address problems that don't exist anymore, they are unduly burdensome, they wouldn't survive a rigorous cost-benefit analysis. And so the president put out a number of executive orders early on to attempt to address that. So, for example, one thing we did was we went through the regs that Treasury has promulgated, and we tried to identify those that are actually no longer in force, because those regs are still in the books. People regard them, people find them and think that they have to comply, and yet they are of no value whatsoever, and that's a pure deadweight loss to the economy. And so we pulled something like 300 regs off the books that literally, those still sitting on the books, had no legal effect whatsoever. We took a look at what regs had been promulgated in the recent past and it subjected them to rigorous cost-benefit analysis and determined that there were a number of them that we actually could pull down without, that were going to impose greater costs than their benefits. And on a going forward basis, we've put in place mechanisms where essentially every regulation that gets promulgated out of our department, and there are similar mechanisms in place with regard to other departments, every regulation is subjected to a review from not just those who are proponents of the regulation, but a committee that's responsible for evaluating whether the regulation is efficient, effective, and appropriately tailored, whether it's going to have benefits that justify the costs. And so when you're a proponent of a regulation in our department and in other departments, you have to come and explain to a set of people who are in the management of the department why that regulation makes sense. And so, for example, we've promulgated a number of regulations recently, for example, with regard to the recent tax reform bill in the United States. But there are a lot of things that I think would have gotten done, would have slipped through the system in the past that a hard look has said, this is actually not beneficial to the economy.
So how often does that committee tell people to go away?
It goes, it happens more than, it makes you somewhat unpopular in the department to be on the committee because you spend your time saying, great idea, not worth the costs, will impose, costs on the economy that are not justified by the benefits. The committee meets very regularly, and every major regulation we promulgate goes through that committee and needs that committee's sign-off. Now, some of them are perfectly innocuous, some of them are truly beneficial, and some of them are not, and they die on the vine.
I think there's one huge difference between Europe and the US when it comes to this kind of regulatory hygiene. And it's not necessarily just the internal process that the regulators have in terms of measuring cost and impact assessment, but the access to redress by private parties when they feel that things have gone too far, which in the US is real, is used, and really does serve, whenever we are addressing regulators and provide data, we see that whatever that data is, wherever that data is being provided, it's being taken into account. A lot of the times on the other side of the Atlantic, the feeling is different. But then when the rules are made, if you disagree with an agency that you think has gone too far in terms of interpreting the law, like on securitization and the risk retention rules we saw on CLOs in the US, there's a way of correcting some of those excesses, whereas in Europe, unfortunately, we don't have any of that. For European law, private parties just do not have standing in areas where some of the regulatory rules may be ultra vires, and I find that extraordinary. And
I think Mike and Scott and I will all tell you that is a very real check on agency regulation. If you are concerned that your regulation is going to be struck down or modified by a court, you are going to be very skittish about promulgating it. Different administrations take different views of that risk, but I can tell you we are very, it's something we take very seriously, and we try to hew closely to the letter of the law for exactly that reason.
Yeah, to that point, so the Securities and Exchange Commission, one of the statute, what the SEC has to take into account or face the risk of potential litigation is to take the effect on competition. So oftentimes, if we do a cost-benefit analysis, it's not necessarily a binary choice. Do we move forward with a regulation or not? It's taking into account, well, what is the effect on smaller entities versus larger entities? And what we see is that, I think it was Brent who brought up sort of this one-size-fits-all regulation doesn't always work. And if you do a one-size-fits-all regulation that has high fixed costs, that benefits the larger companies, the incumbents, at the expense of competition from some of the smaller firms. And so one of the sort of, you can't really measure it, but the unintended consequences of regulation where you have high fixed costs, where the big firms are able to sort of amortize these costs, is that you have higher barriers of entry, lower competition, and so you have fewer sort of innovative firms coming into the market. And so that's something that we have to take into account, and something that I was always mindful of as a regulator moving forward on this is there a way to do tailored regulation for the smaller entities, exempt them outright, maybe delay implementation for them, and so the regulatory costs can go down? Is there like maybe scaled regulation, all those types of things? And so that's again sort of calibrating it appropriately and not just having a one-size-fits-all. Maybe for the bigger banks have one, the medium banks and the smaller banks, and trying to get that calibration just right.
If I can give an example of that from recent history, actually, in the anti-money laundering space, it's become very clear that the set of money laundering mechanisms that are put in place, they are burdensome to banks. There's no question about that. We get massive benefit from them in terms of preventing money laundering. But if you look at the smallest banks, they are proportionally a much greater burden on the smaller banks than they are on the larger banks, which are capable of carrying those costs and having very sophisticated AML functions. And so in the recent past, we've put out policy guidance with the federal banking regulators saying that smaller banks they're required to have certain certain AML programs in place and certain AML officers and things like that. And they can share those resources across the smaller banks as long as they still have an effective mechanism. They don't all have to hire their own person on these things. And similarly, yesterday we put out a statement saying that we are in favor of innovation in the AML space. And there's been some concern about that in the past, that there's a very static AML system. The federal banking regulators and we are very in favor of innovation in the space. As long as we're accomplishing the mission, how it gets accomplished, we're in favor of making it more effective and more efficient, as long as we're accomplishing the mission. And so we're trying to get ahead of those sorts of concerns that Mike articulated about the fact that some of the regulatory burdens fall disproportionately on small entities.
I think we can probably take some questions if folks in the audience have anything they want to put to the panelists. Let's see what the demand is like. I think there's a microphone as well, so we've got one there, and then we'll take one from.
I just wondered if the panel has any view on MiFID II, given those comments about impacting smaller firms, and also potentially on the regulatory arbitrage that MiFID II is potentially causing.
Jiří, do you want to?
So I started my career in the European Commission writing the level 2 on MiFID I, which turned out to be the good MiFID. And
it's all relative.
At the time, it was the most horrendous thing coming to the European capital markets, but then has been superseded. I think that the level of prescription and detail in MiFID II is somewhat excessive. And that was the big elephant in the room when the CMU project was started, right? MiFID II was still not finished, yet we were talking about capital markets union and looking at regulation to promote capital markets, but the biggest piece was still worked on and was not going to be reviewed. So I think it will have to be assessing and evaluating the impact of it on competition, on capital formation will have to be a priority for the next commission if they are serious about broadening capital markets. There's no other way.
Yeah, so when I first heard about MiFID II, I think it might have been Jiří was one of the first people that came over and sort of warned us about MiFID II. I was a commissioner at the Securities and Exchange Commission for 5 years. And for about a 1-year period, we were very, very focused on what potential consequences of MiFID II were to U.S. regulated firms. And so it's probably not worth going into detail here, but there were going to be consequences of if U.S. firms were either going to comply or not comply with MiFID II, what implications that would have under our regulatory framework in the United States, right? So sort of the reverse of DoddFrank, right? So DoddFrank, we sort of exported regulation to a lot of other jurisdictions, if you will, a number of things. MiFID II was going to have a similar type of thing. So what we decided to do with the SEC, there was a lot of questions around it. There were sort of, I call it 3 phases of MiFID II. People coming to us, phase 1 was, oh my gosh, MiFID II. And we said, okay, what? And they would say, oh my gosh, MiFID II. And they couldn't articulate what the potential problems were. Phase 2 was, these are all the problems that are coming, but you talk to 3 different people and they'd have 3 different solutions. And we said, all right, come back and start thinking about this. And then phase 3 was finally coalescing around potential solutions. What the SEC's approach was, and we were talking to a lot of conversations with market participants, was to basically buy some time. And so what we did was instituted through 3 what are called no action relief letters, basically bought some time for 30 months after MiFID II. Now, we're coming up on the 1-year sort of anniversary of that. 30 months does not necessarily mean 30 months. But what it did was we said, look, we're not going to have any sort of collateral consequences in the U.S. regulatory framework from MiFID II until we sort of figure out what the consequences here are. And so it bought us some time. It allows the SEC to use data, figure out how people are complying with things, and then sort of deal with it at some point in the future.
If I could add to that, MiFID II has been in place a year, so we're beginning to figure out what the calibrations are, what their ramifications, because it is a massive piece of legislation and a huge consequence to the market. So as we digest this, we're thinking about where do we go from here? How does it align with international rules, and where do we find opportunities for comparability assessments and substituted compliance? You throw Brexit on top of that, and you have a huge implication because you've just taken, when you calibrated all these rules, the UK was in. Now they're going to be out potentially, and under what circumstances? And that contributed a significant amount to its transparency and liquidity requirements in terms of where we set the bar on trade execution, et cetera. So now we have to recalibrate all of that potentially. We don't know, we'll know in a week or two, I guess, what the outcome of the withdrawal agreement might be, but that's going to have a huge consequence as well. So, we do respect the fact that obviously the European Commission has its rules and has its requirements. We have to figure out where we can align those rules and try to sort that out and make sure that there's a good dialogue in the various international organizations to sort through the complicated equivalency determinations. Because at the end of the day, you actually have an outcome that's largely consistent with DoddFrank. So let's take that and identify the successes there. Let's identify the risk rules versus the non-risk rules, and then make some headway in terms of how do you give equivalence and substitute compliance so people can work through these various questions, and you'll get the same result. The results are going to be the same. So there's a dialogue that has to go on, and it has to accelerate actually.
I think the irony of the whole thing is that 5 years ago, it was the European Commission going out to the world and saying, let's work on equivalence, let's work on mutual recognition. Today it's Chair Giancarlo who's got a wonderful white paper out there saying the same thing, but that message not necessarily falling on a fertile ground. But I think that has to be the way forward, because that sort of further deterioration, further fragmentation is just not going to help anybody, and hopefully we will get to a more sensible place.
And then we have this gentleman here in the second row.
A rather different area, but I'd be interested in the panel's personal observations and thoughts on this. It's about the quality of human capital in the regulated financial industry since the crisis. It's a well-known fact that the biggest employment growth area in most financial institutions is in compliance and regulatory compliance-related functions. But I'm interested to know, as somebody, when I've seen the quality of people applying to join institutions right from the graduate level, these days, the best and brightest graduates generally don't seem to apply to regulated financial institutions. They want to go and work for Amazon and Apple and things outside the space. Have you got any thoughts and comments about the quality of what the state of play is and this burden of regulation is doing to the quality of human capital in the industry in the longer term?
If I can, I think our members are looking at how we adjust to the new regime. The costs, I think we've articulated, are significant with the new regulation. The industry is not waiting for regulatory relief or just begging for solutions from the regulators that gave us the regulations. They're now assessing what can we do within the regulations and how do we optimize that performance. So technology is going to be a huge leverage tool for us in terms of how we automate and innovate the technology. There's a lot going on here in London in terms of FinTech, as well as the US and Southeast Asia as well. And we're really beginning to think about how do you take what we have today and optimize it. So not everybody might be recruiting people for trading roles, and we certainly are recruiting for compliance roles. That's a fact. But we're also thinking about the technology features and how do you think about this? For example, is developing a new data solution to represent the life cycle of a trade. It's not standardized. Banks hold data around the life cycle of the trade, and they describe life cycle events in completely bespoke ways because it was a bespoke market. So now we have the opportunity to standardize that, which brings the opportunity for innovation at scale. So we're thinking about how we do that and disrupt ourselves from the inside out. So we do need a lot of those new Amazon people who are thinking about Amazon, thinking about Google. They should really think about coming to the financial services because we need to develop those solutions all by ourselves.
Yeah, and just pick up on a couple points there, right? So right after Dodd-Frank was passed, I had actually people argue with me that Dodd-Frank was actually a job creator because it created compliance jobs, right, throughout the industries. Now, of course, right, the opportunity cost of hiring someone for compliance is you get to spend those dollars on productive activities to grow the business and to turn around, and whether if you're a bank to give credit or whatever else, that's what it is. And Scott brings up an excellent point. We're seeing an incredible amount of innovation and smart people going into FinTech. Now, these are startup companies. There's maybe some incumbents and stuff. They're not necessarily in the regulated financial sector that you're seeing, but they're providing products and services and platforms to that. So at the Milken Institute, we have a number of folks working in the FinTech space, and we're seeing it in the insurance space, we're seeing it in the banking space, we're seeing it in the security space. And what they're doing is they're finding opportunities, yes, to get the foot in the door on just sort of check-the-box compliance, but the fact that you're using things like machine learning and artificial intelligence and other types of things, you're getting incredibly smart people that now have access to a lot of data that then they can use and to do value-added services as well. So I'm actually very bullish and very positive on the amount of human capital. Pardon me? Well, not yet. So some of these are sort of in the startup, sort of they're service providers to the regulated sector, and the regulated sector is either doing licensing or joint ventures, or in some cases buying them up. And so we're seeing an incredible amount of innovation sort of on the periphery of this. And so I'm very bullish.
We are seeing it in the regulated sector. They have to be. You can't make progress. You can't find cost reduction and efficiency without taking some of those jobs in-house. We're not going to count on Google to solve all of our problems in the banking sector. Most of it is a very bespoke sort of business and relationship, and those are systems that are kind of closed systems. So you want to make sure that you can disrupt from within. So yes, we are. Any firm who is not hiring that talent is going to be left behind.
I think we have time for one more question here at the front.
Thank you. You described in one of your earlier answers regulated companies as having an inbuilt advantage because they had compliance departments, and that gave them a kind of an inbuilt advantage as regulation came in because they had the infrastructure, the human capital capable of dealing with regulations as they came in. Is this not just a huge barrier to their future ability to be able to innovate? Because the classic anaphylactic shock compliance reaction is quite paralyzing for large organizations. And isn't there an advantage for those organizations that can really metabolize not fintech in the way you described it, but regulatory technology, regtech, in order to be able to provide a more sophisticated, faster, more effective, but also more innovative response to regulation? What are you doing to stimulate that?
Yeah, and so this is where Treasury in their most recent report came out with it, on the report on innovation, where the Treasury was very forward-leaning in saying to the regulators, you need to start thinking outside the box, and you need to start allowing for more innovative type solutions. It's not the old school sort of, if you're the big firm, you can hire the big law firm, you can hire the big consulting firm to come in and do your business this way, but allowing for more innovative type things and allowing for things like hiring a fintech firm and coming in and doing AI and other sorts of things to come in to think about sort of leveraging these things in a way that's very, it's a different mentality, right? I mean, as Brent was saying, sort of regulators want to regulate and sort of think that way. But you're seeing a response among the regulators on this. You're seeing for the first time the financial regulators opening up offices of innovation, and they call them different things. So at the Commodity Futures Trading Commission, they have what's called Lab CFTC, which is actually run by a guy named Dan Gorfine, who used to be affiliated with the Milken Institute, for part of it. And so he's doing that, right? You saw the SEC just announced a couple weeks ago that they were going to open up an office of innovation. You see it from the FDIC, the banking regulator, the same thing. And so this is a tangible way that the regulators are sort of seeing that there are these other solutions that are out there. It's going to take some time to sort of change that mentality, but it is a way that you're seeing tangible movement in this area.
And internationally as well, the FCA is moving on this.
Yeah, so that's right. Yeah, great partners with the SEC in this space, yeah.
And over time, it's just going to be also an issue of competition. I mean, you can, in order to solve a short-term problem, hire a lot of people, but over the long term, if you don't know how to optimize these processes, you're just going to suffer. And so I think that's the natural progression. And we see that also among smaller firms, even in many ways, more urgent need for searching for technology solutions, precisely because they can't afford to hire as many people and they want to stay competitive. So it's not just a problem for larger firms and institutions with large compliance departments.
I think it's the advantage for those people that aren't burdened with those huge compliance departments.
So sadly, that's all the time we have for today. You can continue the conversation online on Twitter at Milken Institute and #AIMAGlobal. Video of this panel and other panels will be available at milkeninstitute.org. And there's also the mobile app, and please give us feedback on this panel. It should only take about a minute. Thank you to the panelists, and thank you for being here.